This week's CPI report showed inflation heating up again, which is bad news for mortgage rates. And lodging away from home, car insurance, and used car prices were to blame for that. Shelter costs are still lagging in the numbers, but using real-time numbers, inflation would actually be near the Fed's 2% target. And retail sales came in a lot weaker than expected, the slowest in 2 years actually, and that did help the mortgage bond market. Americans are carrying record high credit card debt, and that spending just can't keep up forever. On the bright side, a slowing economy typically leads to lower rates, so this is positive for mortgage rates in the long run. And the Fed's favorite measure of inflation, that's PCE, personal consumption expenditures, comes out at the end of the month, and that's going to be a key market mover. This week, we did have Powell testify before Congress, but nothing really shook up the markets. Same with the 10-year and 30-year bond auctions that we had. They really didn't have much impact on rates. If you're a realtor, this should make you happy. 19% of homeowners are considering selling in the next 3 years, and almost half are planning to list within a year, according to a study by Zillow. And if the reasons for wanting to sell are of interest to you, just let me know and I can send them over. And in case you don't already know, it's hard to buy a house these days. The median first-time homebuyer age jumped from 28 in 1991 all the way to 38 today. Next week is going to be a little bit quieter with housing data and Fed minutes, but the big one to watch again is going to be the PCE on February 28th. And if we see inflation cool, rates could improve. But basically, inflation didn't cooperate this week, but the slowing retail sales and growing housing inventory could help mortgage rates trend lower over time. But have a great weekend, and I'll see you next Friday.